The government bail out Silicon Valley Bank this weekend? Yes and no. Let me explain. But before I do, I really want you to understand the severity of the situation. The second and third largest bank failures in US history happened within 3 days of each other. This is unprecedented. So last night, the Treasury Department, the Federal Reserve, and the FDIC announced their plan to save the banking system from $300 billion in losses. All depositors at Silicon Valley Bank will have access to all of their money. They're going to be made whole today. That includes balances above the $250,000 insured limit. But shareholders and debt holders are completely wiped out. They lose everything. So technically, it's not a bailout in that sense. Further, it's not taxpayers bailing out the banks, but it's the banks themselves. They are using what's called the Deposit Insurance Fund that is part of the FDIC and funded by quarterly fees from FDIC-insured financial institutions, as well as interest on funds invested in government bonds. And so it's those fees that are going to pay for the losses. And this rescue plan applies to another bank too, Signature Bank, which was shut down this weekend. Their depositors will be made whole. So how does the rescue plan work exactly? Well, it's called the Bank Term Funding Program, and it creates a new backstop that offers 1-year loans to banks, which they will be able to collateralize against held to maturity assets at par. That's 100 cents on the dollar instead of fair market value. So essentially this means that banks sitting on large unrealized losses can borrow against those assets as if they hadn't lost value. Meanwhile, investors are dumping regional banks